Hello and welcome to Persistent Finances. We're thrilled to have you with us today. We're about to embark on a fascinating journey to explore the intriguing world of personal finance and specifically how the affluent utilize debt to their advantage. This might seem counterintuitive because for many debt is often viewed as a financial burden, but the wealthy, they see it differently. They see it as a tool, a stepping stone to greater wealth. We'll delve into various strategies from real estate investments to innovative financial maneuvers. We'll also take a look at some real-life examples, like the story of the man who bought the rights to McDonald's from its original owners. But remember, every investment carries its own set of risks, and it's crucial to tread carefully. So buckle up for an enlightening ride. Stay with us till the end for some valuable insights. Before we dive into the strategies, let's first understand what we mean by making money with debt. Debt, in its simplest form, is money that is borrowed and expected to be paid back with interest. Despite its negative connotation, debt can be a powerful tool if used wisely. It's like a double-edged sword. It can either make you or break you. Now let's talk about leveraging debt. Leveraging is the strategy of using borrowed money in an attempt to increase the potential return of an investment. It's like a financial seesaw. The more you borrow, the higher the potential return, and consequently, the higher the risk. There are two types of debt: good debt and bad debt. Good debt is an investment that will grow in value or generate long-term income. Think of it as a seed that you plant today to enjoy its fruits tomorrow. On the other hand, bad debt is generally incurred to purchase things that quickly lose their value and do not generate long-term income. This is the debt that leaves you with a financial hangover. Imagine buying a house using a mortgage, which is a type of good debt. You're borrowing money to invest in a property that will potentially appreciate over time. Plus, you can rent it out for a steady stream of income. That's making money with debt. Compare this to borrowing money to buy a fancy car. Sure, you'll turn heads on the street, but the value of the car depreciates over time and it doesn't bring in any income. That's an example of bad debt. So when we talk about making money with debt, we're primarily focusing on good debt, the kind that can help you generate income or wealth. It's about being strategic with your borrowing and making your debt work for you, instead of being a slave to it. Now that we have a basic understanding of debt, let's delve into the strategies used by the wealthy. One of the most common ways the rich use debt is through real estate investments. This strategy is as old as dirt, but it's still as effective as ever. So, how does it work? Well, let's dive into it. The wealthy often take out loans to purchase properties instead of using their own money. This might sound counterintuitive at first, but here's the catch. They're not buying just any property. They're investing in assets that generate income, either through rent or resale. This income, in turn, covers the debt payments and often leaves a tidy profit on top. Take an apartment building, for instance. A savvy investor might take out a loan to acquire this property, then rent out the units. The rent collected not only covers the monthly loan payments but also creates a steady cash flow. And over time, as the property appreciates in value, the investor can sell it off at a higher price, repaying the remaining debt and pocketing the difference. Perhaps one of the most famous examples of this strategy is Ray Kroc, the man who bought the rights to McDonald's. He didn't just see the potential in selling burgers, but in the real estate beneath those golden arches. He used debt to buy the land on which McDonald's franchises were built, then leased it back to the franchisees. This strategy not only provided a steady income stream but also allowed him to amass a real estate portfolio worth billions. But remember, while real estate can be lucrative, it's not without risks. The market can fluctuate, tenants can default, and properties can depreciate. That's why it's crucial for investors to do their homework and consider all the factors before taking the plunge. It's also a good idea to diversify your investments so you're not putting all your eggs in one basket. So there you have it. Using debt to create wealth through real estate investments. It's a strategy that has stood the test of time, and with good reason. But as with all things in life, it requires careful planning, a level head, and a willingness to take calculated risks. Scene script. Real estate isn't the only way to make money with debt. There are other strategies too. One can also consider purchasing businesses. Yes, you heard it right. Buying an already established business can be a lucrative way to generate income. This strategy often involves leveraging debt to acquire a business that's already profitable. The cash flow from the business can then be used to pay down the debt, and any remaining profits are yours to keep. Investing in stocks or bonds using borrowed money is another strategy. This is known as margin trading. Here you borrow money to buy more stocks or bonds than you could with just your own cash. The idea is that the returns on these investments will outpace the interest on the borrowed money. But remember, margin trading can be risky. If the investments don't perform as expected, you could end up owing more than you initially borrowed. So it's crucial to conduct thorough research and understand the risks involved before diving in. Similarly, investing in a startup business or a new venture is another strategy that involves debt. Here, you lend money to a business in its initial stages with the expectation that the business will grow and you'll receive a return on your investment. This is often done through venture capital or angel investing. Lastly, let's talk about leveraged buyouts. This is a strategy where you borrow a large amount of money to acquire a controlling interest in a company. Once you have control, you can make changes to improve the company's profitability. The profits can then be used to pay off the debt. Now, these strategies are not for everyone. They require a deep understanding of financial markets and a high tolerance for risk. Remember, with higher potential returns come higher potential risks. And it's essential to do thorough research and risk assessment before embarking on any of these strategies. As with any investment, these strategies come with their own sets of risks and rewards. We hope you found this discussion enlightening and useful. We've explored the concept of leveraging debt, a strategy often employed by the wealthy to generate wealth. We've delved into the realm of real estate investments, illustrating how purchasing properties to rent or resell can yield significant profits. We've also discussed other strategies such as buying rights or businesses, and how these can lead to substantial financial gains. Remember, every investment carries inherent risk, so it's crucial to approach each opportunity with caution, research, and due diligence. Now, if you found this content valuable, we encourage you to express your appreciation by giving us a thumbs up. Also, don't forget to share this video with others who might benefit from it. And of course, subscribe to our channel and hit the notification bell to stay updated with more such enriching content. Thank you for allowing us into your homes, workplaces, and study centers. It's an honor to share this space with you. If you enjoyed this video, please give it a like. Subscribe to our channel and hit the notification bell. It's free. See you in the next video. Thank you. But before we go, we have a crucial reminder for you. As we've explored today, the world of finance is vast and intriguing with myriad opportunities for growth and wealth creation. However, it's crucial to remember that every investment, every strategy, comes with its own set of risks. The tales of success we've shared today, from real estate moguls to savvy debt strategists, are indeed inspiring. Yet, they should not overshadow the fact that these successes are often the result of careful planning, strategic decision-making, and a deep understanding of the financial landscape. Investment, at its core, is a calculated gamble. The stakes are high and the potential rewards are enticing, but the risk of loss is ever present. So before you dive headfirst into real estate or any other form of debt investment, it's vital to do your due diligence. Research, consult with professionals, understand the market dynamics, and assess your risk tolerance. Don't let the allure of quick riches cloud your judgment, and always ensure that you're making informed decisions. Remember, the stories of the wealthy making money with debt are not just about leveraging debt, but about leveraging knowledge. Knowledge about the market, about the timing, about the legalities, and about the potential pitfalls. They're about understanding the ins and outs of financial management, about making strategic choices, and about having the patience to wait for the right opportunity. And finally, it's about risk management. No investment is entirely safe, and it's essential to be prepared for any potential setbacks. The key is to balance your portfolio, to not put all your eggs in one basket, and to ensure that you have a safety net in place should things not go as planned. Remember, the key to successful investing is knowledge, patience, and risk management. Thank you for joining us today, and we look forward to seeing you next time. In this journey of financial discovery, we're here with you every step of the way, providing insights, sharing strategies, and helping you navigate the intricate world of personal finance. We hope you found today's discussion enlightening, and we're excited to continue this journey with you. Until next time, stay savvy, stay smart, and stay tuned.